Hello, and today I'm going to do a stock analysis update for IGas. Before I start, please remember that I do these videos just for fun as a hobby and always speak to a qualified professional financial advisor before making any investment decision. If you go to my channel, you'll see that back about 8 months ago, I did a couple of other videos on IGas, including this one here that's 54 minutes long, and then this one here as well has important updates. So if you really are interested in IGas, make sure you look at those videos which go into all kinds of depth not covered in this. This is going to be an update video because they've just come out with their annual report, so I'm going to take a fresh look at them with that information. And also now that the dust has settled following the shale gas catastrophe. So now the shale gas is completely out of the picture. I originally invested in them because this was their market cap. And this is what their shale gas assets were promising to bring in, according to my estimation. But even though the government said that they were going to support shale gas, a month later they then banned shale gas. So now the shale gas is completely out of the picture. And actually, the majority of this company is all about their oil assets. They have these onshore oil pumps throughout the UK. They're actually the UK's second largest producer of onshore oil. Now they also have deep geothermal as part of their strategy, so I'll take a look at that as well. So in terms of news flow, both Rishi Sunak and Liz Truss were promising that they were going to support shale gas, and that's when I then went into the company around here. And indeed the government on the 8th of September did lift the shale moratorium, and under really strange circumstances the CEO was booted. He was called Stephen Bowler, and he'd been with the company for ages, and I found it very strange how he was ousted from the board. Then on the 20th of October, only roughly a month after she came in, Liz Truss was forced to resign in a political coup, and Rishi Sunak came in, and within a few weeks of him coming in, he then went and banned fracking. And because the actual news flow of the banning happening didn't happen until quite some time after the share price started dropping, that's how I ended up trapped. What has been probably my worst ever investment. It was only a small percentage of my overall portfolio. It's my worst investment ever in percentage terms. But that's why I'm now taking a look at them now that the dust has settled. And the only RNSs we've had recently is that they've received planning permission for one of their oil projects at Glentworth, and they've come out of their annual report. So let's take a quick look at their annual report, which is entitled Accelerating the Energy Transition. And this is their new CEO, who was kind of placed in there to then oust their previous CEO. And there's a lot of talk where he gives the impression that he's shaking the whole operation up, improving efficiency, talking about abandoning some of their wells that are higher cost, and generally boosting production. He talks here about a production dashboard which tracks performance and provides a summary of our weekly priority work activities. He's given the impression of being a real go-getter, reshaping the business. I guess time will tell. We see that there's a 7% attrition normally with this business. So they have a portfolio of late life wells, and that means a 7% attrition rate every year. But they are able to keep the production up by doing little development projects here and there. So I'm going to go into detail on the conventional and then the geothermal. So with the conventional, and please remember that that really is the vast majority of what this business is about. We can see that they have been quite effective in keeping their 2P reserves elevated over the last 5 years. They have two main territories, which are the south and the north. And within here, we see here detailed all their individual oil fields that they own. And I do find it really cool that in the UK, there are dotted around our land these hidden away Texas-style oil rigs still producing oil locally. So updates from my last video are that they're doing some work on this Bletchingley field where which produces gas, and then they're going to convert that to grid electricity by building a 6 megawatt power station. And I do think that's a nice niche that IGas have, that they're able to do that, given the energy transition issues that are going to be caused by all of these EVs. That's quite a nice little niche for them, I think. And then we've got the Corringham infill drill, which is going to add 100 barrels per day. And a recent RNS was that they've had planning permission for the Glentworth field extension, which will add 200 barrels per day, with the phase 2 adding 500 barrels per day. And when we see that they produce 2,000 barrels per day overall, you can see that those are actually quite sizable improvements, and this is how they've been able to maintain their reserves actually at these elevated level. And when we look at oil production, that's how they've managed to keep their oil production elevated despite the 7% attrition rate. Now, I've done a lot of oil analysis videos on YouTube, and every video I've been saying I'm not able to find where is the oil in their assets. And I have to say thank you very much to Simon on the Portfolio Matters Discord, who explained to me that for oil companies, the actual oil in the ground that they own isn't actually counted in their assets for valuation purposes, and that to try and estimate what is the worth of the oil in the ground, you have to look at the competent people's reports that the oil companies provide as a separate appendix, as a separate document to their actual financial statements. And so thanks very much. This has been a real wealth of information that really adds to my previous analysis I've done on this and will be on future oil stocks. So what I saw from this document is that the 2P reserves that this company has are about 7 million barrels of oil equivalent. And they also have 2C resources, which are contingent resources of 19 million. Now, this is oil that they know's there, but they can't access, either because it's economically unfeasible, it costs too much to extract it, or there might be political reasons like the local council won't let them drill or whatever. So that gives us some kind of room for them to continue doing their little boosters here and there to make up for the 7% attrition. It gives us kind of a rough idea. And they actually said in their latest RNS that the Glentworth field extension will be taking barrels of oil from their 2C contingency reserves and then adding them to their 2P reserves. So I don't really consider this as assets to value, but it gives me a good idea that they are going to be able to keep on making up for the natural attrition by adding value here and there, by doing water flooding and whatever other techniques to a reasonable extent. And they actually have prospective resources. This is where they've got data that an area may have oil, but they've got to do prospecting drills to prove that. And that equates to 7 million. And 90% of that is in this Godley Bridge field. That's here in the Southern Territory. But according to the competent persons report, there's no kind of work been going. There's no plans to do work on that at the moment, but it's certainly noteworthy. And then they have the 2P MPV10 data, which is the net present value of all the oil they have. And I'm using the proved plus probable as a good kind of reasonable guesstimate, which isn't that much more than just the proved anyway. What these independent experts say the value is of the oil that they're going to be able to sell. And that does also take into account the cost of extracting that oil and also inflation, because a lot of that you won't be extracting until, say, 20 years in the future. Now, all these assumptions, though, are based on $82 Brent. And we see here every year what they think the price of oil is going to be to use that, to do that calculation. So it's important to remember that this asset valuation assumes $82 Brent. I picked out they say here that at the request of IGas, UK income taxes are not considered in the report. Now, I was thinking maybe that's because this company operates perpetually at a loss so that they can get in those tax credits, but I'm not sure. And so that's kind of a dark space of uncertainty that I need to highlight and consider. But they then have this beautiful chart here where they say how much revenue, where you can see how much oil they think they're going to extract every year, and it goes all the way to 2047, plus how much gas, plus how much electricity they're going to be generating on their little power stations they have on certain locations. And so from that, they estimate the future revenues. And then they also consider the expected operating expenses and abandonment and capital costs. So from that, you get your future net revenues, and they then do a 10% adjustment, which I think takes account of inflation, because you won't be extracting some of these resources until in the future when they'll be worth less because of inflation. So then that's how we get this NPV10 data. And this really does help when evaluating oil stocks. And so thanks again, Simon, for alerting me to this wonderful resource. Now, there's certain really interesting things I found out from this. So one thing was, given that these are all late stage assets, which, some of them were set up in the 70s and 80s initially, I was wondering, would there come to a certain point where all of a sudden the oil would just run out like a cliff with most of them, and that could be like a ticking time bomb for this stock. But here we see that actually, although we do have that 7% attrition, there isn't a sudden drawdown. It's actually a gradual drawdown. And also, as time goes on, they can add to the recovery by boosting what they get at some of these projects using flooding, using water flooding, and whatever other things they do. So from this data, I'm not worried about their production falling off a cliff at a certain point. I think that certainly for the next 10 years, it holds up really well, and probably the next 20 years, really. Certainly the next decade, I'm not worried. It's interesting here, we can see how they're actively converting their gas producing sites to gas to grid sites. So that's quite cool. And actually, we see a 6x in the amount of electricity they expect to produce over the next 5 years. So 5 years from now, the electricity will actually be perhaps like a quarter of their revenues. And with what's going on with the UK electricity grid, I think that's a really nice facet to this business. One thing I noticed is that over the next 3 years, we've got a bit of a tsunami of capex and abandonment costs. Now, if we have elevated Brent prices, that won't be so much of a problem, because it could be a nice way of making sure they don't make any money so they can still keep on getting tax credits whilst being in a generally more healthy position. If we have a drop in oil price, sub 70 say, over the next few years, that timed with these increasing costs is kind of quite nasty. So that's something worth highlighting. And here we see the NPV10 for the 2P assessment at around 210 million. That's US dollars. That equates to 168 million sterling over the whole lifetime, and 69 million sterling over the next 5 years. So looking at their conventional portfolio, what I can say is that at $80 oil, it actually looks quite good for them, particularly if I compare back the historical data here. Even if I use the data provided in this report, it does actually then look good for them when I tot it all up. If we end up with sustained lower oil prices, let's say there's a credit crisis or worldwide recession, whatever, then all of a sudden things look quite bad. And I'll perhaps go into detail in that a bit more in a moment. But really, the bottom line is, if we have $80 oil plus, these resources and the general context here, it all holds up very well. Now to move on to the geothermal, and there were two main projects. One is this Stoke-on-Trent project, which is partnered with SSE. Now for this, really, they're hoping they can get a massive multi-million-pound government grant, where because it's green energy, the government are basically just going to give them millions of pounds, and then that will make up for the project not being profitable. So it will be profitable when you count in the free taxpayer money. This Green Heat Network Fund scheme they've applied for, and we're waiting for a decision in early 2023. That was their RNS update in December 22. So the thing is, we're now in May, so I'm a little concerned we've still not heard about this. And then there's also the Carbon Energy Fund, which is again is more taxpayer money, where they're going to cover your end if you invest in a geothermal project. And so for this, in December, we were told that they've applied, and we were told in the annual report we're expected the outcome in the second quarter this year. Well, again, we're kind of coming towards the end of the second quarter this year. So there are two geothermal projects. Now, the news for this could come in any week, and then that could actually provide a pop for the share price. But then again, we're kind of getting a bit late now to when we were promised the information. So let's see. It could provide a nice pop to the share price. Really, though, when evaluating this stock, all that matters, as far as I'm concerned, is what's going on with their oil portfolio. Unless you're gambling, I wouldn't bank on the geothermal. I forgot to mention that in their annual report, they're going to change. They've said that they're going to change the name from IGas to Star Energy. Now, actually, whenever a speculative kind of oil stock says they're going to change their name to Star Energy, I generally look at that with a bit of suspicion, as it kind of worries me. Why do they have to change their name to Star Energy? But that's what they're going to do. Now, I want to touch on derivatives. They were only surviving because of loans they had, and part of the deal was, in order to get those loans, they had to hedge their oil production so that the people lending them money got their end, whatever happened. And what I noticed was, historically, they were hedging around 46% of their production. So actually, 58% of their production was hedged in 21, 42% in 22. And what I noticed is that for 2023, only 10% of their production is hedged. Now, part of this is that they have actually massively paid off their debt when they had the oil bonanza of last year. So that does explain that. But also, I do find it interesting, they got the change of manager to new management. And was this the idea of the new management, I wonder? I think actually, like all of us, they were probably expecting elevated oil prices this year. And of course, against everyone's expectations, the price of oil has been in decline and kind of in this downward channel ever since May last year now. I wonder if they're regretting only hedging 10% of their oil this year. So actually, this is a good point to focus on the oil price. I'm going to be going into it more when I start looking at their income and loss statement. But they've assumed on their competence report around $80 oil, and we're actually, what I noticed actually just in preparing for this video is I'd been seeing us in this channel, but actually if you go back from the start of this year, you could kind of say we're in like a sideways channel. Maybe we're now at this kind of inflection point where either we're in a sideways channel or better, in which case they'll just be about all right as long as it averages about $80. But if this trend continues, and particularly there could be, like, say, a big banking crisis or something, sending us lower here, then they kind of really are in a bit of trouble. If that doesn't happen and we end up in an era of long-term higher oil prices, above $100, things look absolutely amazing for this company. They just get by where we are now, but if we get some serious and sustained drops in oil price, things are going to look really nasty just in time for their name change to Star Energy. So now to look at their profit and loss statement. Like I keep saying, really 90% of what this company is all about their oil revenues, and those had a bumper year in 2022, the higher oil prices. Nothing else really does anything other than this tax credit. Now, these tax credits I kind of don't include in my kind of consideration of general health, if you like, because although they are genuinely positive in terms of their income, really they're a bit of a strange accounting artifact. And what they are is, if you're an oil company, which means you're vital to the UK prosperity, actually, they give them tax credits if they're losing money or if they're basically operating at a loss, like IGas are. That comes in as a positive on their income statement, and it gets transferred to their assets as deferred tax assets, which are basically tax credits deferred to the future. So they're considered an asset because in the future, when they are making money in a royal way, they can actually, rather than being profitable, they can actually pay off the tax credits to then continue operating at a loss to then avoid paying tax. I think that's how it works, but it's something like that. And so I don't consider it good money, if you like, but it is there as part of their income. And then looking at their expenditure, their depletion, depreciation, and amortization is kind of fairly steady, and so I can assume to remain so. Their other cost of sales, they actually said in the annual report, this has increased because of inflation. Higher, they have to pump a lot of water in the ground, and that's quite energy intensive. And so their other cost of sales have increased, and I'd expect them to remain elevated. Now, their administrative expenses, they actually they seem to stay fairly constant. Now, this exploration asset write-offs, now, historically, they've had lots of years where they've had to write off large quantities of their shale assets. In the past, it was because local councils basically just banned them from going anywhere near the site. More recently, we've obviously had the situation where they've just now completely written off all their shale assets because of Richie Sunak. So this is why, actually, in 2022, they would have made a good 20 million or whatever profits. But because of this 30 million write-off, then it meant they ended up 12 million down. But the good news is it's done, and it's all done with once and for all. So moving forward, we don't have to worry about them having to write off shale assets. Now, this goodwill impairment, that's where if there's a shock, reduction, or increase in oil price, that can have a positive or negative effect. So I'm kind of neutral for that when I kind of consider them forward, as I am for the exploration write-offs. They obviously were hedging a lot, and so that's where the derivative losses come in. So actually, for my kind of considerations, I like to be very conservative. So I've assumed that will continue, but actually it's probably going to be, if anything, a positive number actually this year, or less likely. They're only hedging 10% of their portfolio, so it's probably going to be more like 1 million worst case. But just for the sake of being ultra conservative in my considerations, I've kept that at 6. And in terms of non-operating costs, really that's only finance costs, which I can assume to be the same. Being conservative, because it's probably going to be less because they've got a lot less debt than they had before. But the debt's significantly reduced now, and on a bumper year like last year with $90, $100 oil, they really should be looking making like 10 million a year profit, in fact, according to my little rough calculations here. However, if we have, say, $70 oil, I think we're looking at them losing 10 million a year. Now, these are very rough calculations. I use this independent report to help get those numbers. I also then used historical rough guesstimates to then tally it up here, but that's what I've got at. So, if we have sustained or sudden drops in oil price, this company are, like they have throughout history, going to be 10 million in the red. If, however, we have anything above $80 oil, and particularly if we have like $90, $100 oil in for a sustained period of 5 to 10 years, actually this company becomes quite profitable. So looking at their assets, not wanting to cover all this, which I've done so in my previous videos, just looking at more recently, we see that the intangible assets are now much reduced, and that's because they've written off 30 million's worth of shale assets, and the debt is now significantly reduced to only 5 million, so that's quite a positive. So when I look at their composition of their assets, we see that a lot of it is those deferred tax assets, and then a lot of it's the property, plant and equipment. Now, the deferred tax assets, as long as we've got $80, $90 oil for a sustained period of many years, those assets are actually good as gold. And as they start making profits every year, rather than making profits, they can actually pay off these deferred tax assets, and that's all good. If, however, we have sustained low oil price, then if the company then becomes under question as a going concern, then you wonder really what are the value of those assets. The property, plant and equipment is the same thing. If the oil price is above $80 and all these assets can be used to generate oil at a profit, then they are good assets. But at low oil price, who's going to buy all these assets off you if these assets can only produce oil at a loss? So again, at high oil price, these assets are great. Low oil price, they kind of evaporate to nothing. In terms of their debt, it's great that they've got little debt. Their only real liabilities here are their provisions. So that's all of these oil wells. Once they finish their life, the land has to be restored so you can have beautiful farmers' fields on there again. That, in a way, now is kind of a bit of a poison pill that's built up. But then the company can also, when times are good, they're actually quite good because you can start abandoning the old wells as a way to avoid paying taxes and keep on building up the tax credits. At face value, there were these assets. This is their current market cap at 23 million. And then you take away the debt from their assets, and you can see that actually this company, kind of technically on just their assets here and their debts and their liabilities, is very nicely valued with a price to book of 0.4. Now, though, when we consider the oil assets that they have access to through their licensing rights, the 2p NPV10 of this company is 168 million. So as we can see, that considering this, and this company is whoppingly undervalued. However, bear in mind that's only if we get many years of above, let's say, 80, 90, $100 oil. But if that is the case, wow. But I like to actually only consider the next 5 years because I like to be ultra conservative. But then, even then, the next 5 years, they cancel out all their liabilities. And again, this company is kind of 5x at least undervalued. based on that. However, that's only if we get sustained oil above $80 a barrel, and let's say and be safe, $100 a barrel. Remember that if we get sub 70, sub $60 oil for a long period of time, this actually would become a negative actually, and then we're in a very dangerous situation. But oil price where it is at the moment, this company really is on a knife edge between huge gains or huge losses. And I don't know how they could use, say, hedging or something to mitigate that, but as someone who's not an expert, particularly being very cautious as I evaluate as a shareholder, that's how I am going to look at it. So I have my little visualization I do where we have the market cap versus the net assets, and we can see that when you following that restructure and then in recent years the situation has actually generally improved greatly for this company. If we can have improved oil prices, consideration that debt now is going away. Also, we see that with the assuming $80 oil price, the NPV 10 over the next 10 years, makes this company look very undervalued. But of course, remember what I say, if the oil price was to flip lower than $70 or whatever, this starts to become actually a negative value, and then things look horrendous. So let's have a look at oil price again. And really, as far as I can see, at the moment, it's impossible to tell whether we're, maybe even in a sideways channel that I just drew up. And, I'm not a technical expert or anything. Or we could be in this severe downward trend that could be continuing, and maybe there's a credit crisis coming in or what. Like I say, I regard this company as on a knife edge, and this black line here is the $82 a barrel that they had in their best estimates for 2p that I was using to estimate their revenues. So this company really is on a knife edge at the moment, but with spectacular gains possible if we're in long-term elevated oil prices, but also things could start turning quite nasty if we're in this trading pattern here. So my verdict is that IGas, soon to change their name to Star Energy, are on a knife edge. If we get $80 oil this year and enter a decade of $100 plus oil because of a long-term energy crisis, which I do think there's a certain chance of, and so do a few people, then prepare for blast off. But it would probably take a year or two as well for the market to catch on. If, though, again, as actually most commentators are saying, who I follow, we get a bit of a global recession and sub $70 oil for a sustained period, then the assets will evaporate and this company is going to be under extreme stress. So my action is to hold. As soon as I see that oil trend continuing downwards, I'm going to sell. Also, I'll probably set some kind of stop loss, but probably 25% stop loss just on the main share price. But I am ready to sell if those negative trends continue. But if we find us on the other side, if we bottom out now of the oil price and then we see forming a long-term trend of higher oil prices, which is a possibility, if the market doesn't catch up on that with this share price, with this stock, which could well happen because it's a stock that's been just completely nuked, so the market might not catch on, then I'd be loading up actually if that happened. But the time frame for that is anything between 6 months and 2 years. So the risks are basically a sustained or significant drop in oil prices, and that continues. I certainly wouldn't be coming into this stock now, no way. My hold verdict is because I've already got some left over from last time I got burnt. This stock's really on a knife edge. It really could go up or down massively depending on what happens on the oil price. So that completes my stock analysis update for IGas, soon to be rebranded to Star Energy. Play it safe and good luck with your own investments. Please read the disclaimer. Remember that prices can go down as well as up.